Uh, Good morning, good afternoon, good evening, wherever you happen to be. Welcome to the International Macro History Online Seminar, organized by the Graduate Institute Center for Finance and Development in Geneva and the Center for Economic Policy Research. My name is Richard Grossman, and today I am happy to introduce Kilian Rieder of the Österreichische Nationalbank to discuss his paper with Todd Messer of the Fed on commodity price shocks and financial stability, evidence from the 1920s. Before we start, let me just mention a few ground rules. The webinars run for an hour, followed by 15 minutes for additional discussion. If you have questions, please put them in the Q&A space. That's the only way you'll be able to make your questions known. If you have a clarification for the author, please flag it in the Q&A space as #clarification. And if I can, and if it seems like it will move things along, I will interrupt the presenter and pass those along. And then I think that's about it. After about 40 or so minutes, 45 minutes, I'll ask Kilian will stop and I will sort of start to read out some of the Q&As. And when we get to an hour, we'll really let our hair down, those of us who have hair, and we will be able to engage in discussion. And so with that, I will turn it over to you, Kilian.
Okay, I'll share my slides. Okay. Can you see the slides, just to confirm?
Yes.
Perfect. Okay, great. So thanks a lot for having us at the seminar. So this is joint work with Todd, who is at the Fed, and since we are both working for central banks, the usual disclaimer applies to the presentation. So this is a paper basically in which we show how the very same commodity price busts can impact financial stability, that is bank failures in our case, through two different channels. So on the one hand, asset quality, and on the other hand, bank funding liquidity. So the paper is also, in a sense, really an economic history paper, because we think it shows how much it can matter to have really fine-grained good data or microdata to disentangle the historical channels at play. And it also sort of shows what we miss out on if we don't have that kind of data. So our main outcome of interest in this paper are historical US bank failures. And what you can see in this first kind of slide here is just a count of US bank suspensions between 1910 and 1940. And as you'll know, of course, a lot of papers have been written about bank failures during the Great Depression. So the big spikes here on the right-hand side of the graph. What we're going to focus on in this paper is the bank suspensions that happened in the 10 years before that, so during the 1920s. And we do that for two reasons mainly. So first of all, these bank failures in the 1920s, we think that they are important. On the one hand, so due to their extent, so about 5,700 banks suspended during this period, and the number of active banks fell by about 18%. And these failures also had harsh consequences. So, for example, lots of rural communities in the US lost access to credits and became more vulnerable to later shocks. The bank failures are also associated with persistent land price collapses during the 1920s, and some of these actually lasted until the 1960s, as some of the papers on this period show. And then finally, there's of course this large debate about whether the 1920s or the bank failures during the 1920s also contributed to the banking panics or the breakout of banking panics during the Great Depression. But that's one reason why we focus on the 1920s. The second reason is essentially what is shown in this graph. There was a huge commodity price bust at the beginning of the 1920s. And we show this here in the form of specifically was an agricultural commodity price bust. And we show this here in the form of the agricultural commodity price index, here plotted between 1910 and 1920. So you see this boom between 1915 and 1920, and afterwards a relative sharp decline in agricultural commodity prices relative to peak in the years thereafter. So the conventional story about the bank failures during the 1920s has been one of asset side losses due to the exposure to agriculture that's gone bad, essentially. So what we do in this paper is we provide evidence for another complementary channel to bank failures during that period. Namely, what we argue is that the loss of local funding due to deposit withdrawals played a large role also in bank exits during this period. So we provide a theoretical framework that allows us to establish a direct link between deposit withdrawals and the agricultural income shock that we just saw in the graph on the slide before. Deposit withdrawals also linked in that framework to expectations about future prices, so expectations by the farmers themselves, so by people involved in agriculture about future prices, and about their decision to default or not to default on their mortgage loans or their loans more generally. So we complement that theoretical framework with empirical evidence. We show that withdrawals are strongly associated indeed with that income shock, as you might expect, but also with expected future farm prices or expectations about future farm prices. And then we also show, and that's sort of the main horse race in the paper that we do, that the bank exits are predicted by withdrawals even after we control for a very fine-grained new proxy for the asset side impact of the commodity price bust, essentially. So when we run this horse race, we find that the effect of withdrawals is actually several orders of magnitude larger than that of the asset side impact. So what literature do we contribute to in this paper? First of all, we contribute to the literature on the financial stability impact of commodity price shocks. So there is a small but growing literature on this specific topic, but most of these papers are actually cross-country. So there's little evidence on the precise channels, and what we do in this paper is we document both the solvency and the liquidity prongs of the commodity price shock, and also a little bit, so we also have something to say about the links, essentially. And second, of course, we contribute to the literature on the US bank failures in the 1920s. So lots of papers have focused on the asset side losses. In this context, we say that there is also a crucial role of withdrawals to be reckoned with here. Then we contribute to the literature on the backstory of the Great Depression. So while there have been a couple of papers on the crucial role of price recovery, of price expectations in the recovery from the Depression in the 1930s, we show that commodity price expectations during the 1920s help explain sort of the backstory to the Great Depression, that is the bank failures before. And then in terms of economic history data contributions, we have two novel databases that this paper is really built around, and that allow us to write the paper, actually. Namely, first of all, there's we compile a novel database on annual county level transfers of farm real estate that covers each year between 1900 and 1935. And we also have a database on monthly data on future prices. So that's what we use for price expectations for major agricultural crops between 1920 and 1930. So let me start off by talking a little bit about the historical background first, just to set the scene, essentially. So I've already mentioned the agricultural boom and bust cycle that this paper is written against. So essentially, why did that happen? So one was really a really large external demand shock for US agriculture because of the disruption in the European supply, also because of the Russian supply disruption due to the revolution. So there was a very strong rise in crop prices during the war, up to more than 150% in the years following 1915. And as a consequence of that, the commodity price increases, we also saw a massive farmland price boom in the US, partly because farmers sought to expand their production capacities in reaction to the price boom. And so we see farmland values per acre increase by more than 50% between 1910 and 1920. We see improved acreage doubling, mortgage indebtedness rises substantially by 83% over these years as well. The problem was just that just after armistice, so just after the war was over, there was a really fast European recovery that was unexpected from the perspective of the agricultural of the US farmers. So we see a collapse in commodity and US farmland prices after 1920, both of which led to both a really sharp income shock and also an equity shock for the farmers who owned the land. And we know, and that has been quite well documented, that there were really widespread foreclosures of farm real estate that happened during the 1920s. We also, and that was kind of the link to where we are going then in this paper. We also see large-scale bank suspensions, and the conventional story is essentially, well, it's because of this collapse that then affected farm debts or the ability of farmers to repay, that banks suffered from bad agricultural debts and repossessed a lot of the collateral from secured loans, and the depreciation associated with repossessed collateral then also cut into to bank equity, led to losses and so forth. And that's sort of the conventional story. So that's one part of the history, the historical background that is important. The second part that is also important to understand is, what happened or how delinquent farm debt was actually resolved at the time. So there were essentially three major ways of doing that. First of all, there was sort of a one by more or less mutual agreement, so kind of informal settlement with the creditors, so by mutual accord that often involved some leniency, forbearance as well, and that could then end in the assignment of the property, for example, part of the land, to the creditor in order to fulfill the debt, if there was no other way to repay it. Another way to resolve farm debts that were in default was essentially bankruptcy. But what is important to note is that farmers at the time were actually exempt from involuntary petitions. So that means that creditors could not force farmers into bankruptcy. Farmers had to declare bankruptcy themselves, so they had to choose bankruptcy themselves, essentially, for this to happen. And if that was happening, the court then apportioned all the assets of the farmer in default, apportioned the assets to the creditors, subject to certain exemptions like homestead exemptions and so forth. Third way of resolving farm debt was foreclosure according to state law. And here actually creditors could force farmers into foreclosure upon default. And the only kind of condition here were certain were so-called redemption periods. Those are the periods during which the farmer actually had the possibility to redeem his debt in some way in order to avoid foreclosure. And these redemption periods, they actually varied across states and they were really between only several months up to 24 months. In this case, in the case of foreclosure, we have either a judicial auction by the sheriff of the property or the collateral, or in some cases, when this was stipulated in the contract, we also have power of sale clauses where the creditor could directly then sell the collateral that he was pledged. Okay, so this is basically the background to our paper, to understand where this all is set. What kind of new data do we bring to the table, and why is this important? So what we do in this paper is essentially we build our paper around a new, very precise proxy for the asset side impact of this commodity price bust. So the previous papers on US bank failures during that period have either relied on annual state level data from the Department of Agriculture, or something like farm foreclosure rates at the state level, or they have relied on county specific changes or levels from the decennial censuses from 1910 or 1920. But these were proxies like, for example, the debt per acre, or changes in the debt per acre from 1910 to 1920, or the land value, or improved acres, and so forth. What we have, and what is so to say the new data component here, is we have a new database on transfers of farm real estate that we compiled. So for a sample of counties, so it's not all counties in the United States, but it's a sample of counties, namely 485 counties between 1910 and 1935, and this new database covers all forms of voluntary, but also of involuntary transfers of farm real estate during this period at the county level. So we have the number, we have the acres at the county level that get transferred in a specific year. And the source for this novel database is the work program is a report that was commissioned by the Works Progress Administration during the Roosevelt New Deal programs, essentially. Here's an example page from this report. So as you see, it's really detailed. This is for the state of Maine in this case, for several counties here, starting with A, and for the years that we are interested in. So we see on the left-hand side of this picture essentially all the types of voluntary transfers that can take place, whereas on the right-hand side we have the type of involuntary transfers we are mostly interested in here in this paper as a proxy for distress transfers, or for the asset side impact essentially of the commodity pricing bust. So we see foreclosures, assignment to creditors. We also see bankruptcies here, and that's the kind of transfers that we are really interested in. So that's the counties. It's a picture of the counties covered by the WPA report that we use as our data source. We also have much more information on data quality, on the representativeness, and so forth. But I'm going to jump this here now in the interest of time. So please do not hesitate to bring that up if you're interested in how exactly they assembled the data and what kind of data checks they involved, etc. Because we went to the archives to really dig into how this process worked. Now, just two pictures, very simple pictures of regressions regressions of transfers of farm real estate at the county level on a bunch of year dummies, using also county level fixed effects. So what you see here in this first graph is essentially the coefficient on the time dummies for the outcome of voluntary transfers, and it's sort of a sanity check of our data that we can easily convey here in a picture. Namely, what you see is that these voluntary transfers really go up during the years of the boom, so to say 16, 17, 18, 19. And we have like a lot of sales of farmland, and that's exactly what we would expect, given that a lot of farmers try to buy additional land and purchased and sold land during this period. When we go to our measure of involuntary transfers of farm real estate, which for us specifically in this paper includes foreclosures, bankruptcy, and assignment to creditors, which we put together to form to create our proxy for involuntary transfers. In this case, it's always, I forgot to say, it's always normalized by 1,000 farms in the county in a specific in the year that we're interested in. So what you see here is essentially is exactly that kind of consequence of the agricultural commodity price bust that happens after 1919, where slowly but surely the rate of involuntary transfers rises and then stays high throughout the 1920s before exploding again during the Great Depression. So both of these pictures just show that our data really capture the trends that we're interested in. And just to make sure, I show you also how distress transfers are broken down, we made this additional graph here essentially. So this is the number of acres that are transferred according to the three major types of involuntary transfers in our data set, namely assignment to creditors, foreclosures, and bankruptcies. And what you see is that, at least initially, during the beginning of the 1920s, we have this rise of sort of mutual agreement transfers that happen. So you have mostly, first of all, assignment to creditors that go up, but then you see a massive rise in foreclosures over the 1920s, as we already know from other papers. And we also see here sort of what we expect, given that farmers could not be petitioned into bankruptcy, that bankruptcy transfers were actually relatively small in number compared to the other two categories. Now, let me say something about the theoretical framework that we put together for this paper. So we have this really fine-grained, nice proxy for the asset side impact of the commodity price bust that we want to use, but we also think that the lack of adequate data is not really the only problematic aspect of the asset side story. And so before we run the regressions that we do in this paper, we thought it might be a good idea to take a step back essentially and read and think a bit more about the background dynamics that happened at the time and build a little theoretical framework to understand what's going on. So let me start before going into that framework. Let me start telling you a little bit about our points of departures for these concerns with the current story. So first of all, if you believe that that the asset side losses actually came mostly from defaulted mortgage loans, then there are a couple of reasons to believe that the story is not super convincing. So first of all, the majority of mortgage loans did actually not originate, were not originated by banks, but by individuals during that period. And I'm saying this applies to farm mortgage loans specifically. Moreover, mortgage loans in general actually only made up a quite modest share of bank balance sheets at the time. And this applies to specifically to national banks, but it's also true on average for state banks, as you can see here in this graph. So on average, state banks also had massive shares relative to total loans and relative to total assets in terms of mortgage shares. So what we also see is qualitative evidence that shows that most of these loans had quite moderate loan to value ratios, which would mean that banks had actually a relatively large buffer against falling land prices in the years thereafter. And finally, a point that is also a problem with that story is that there were quite a lot of suspensions of national banks, despite, as I already showed you, their really tiny mortgage exposure. So what else could explain actually what is going on, and what could be an additional kind of explanation for bank failures during that period? So we dug into the background literature, the reports at the time that were published by Congress, for example. And the first thing we really came across is this huge report by the Joint Congressional Commission of Agriculture Inquiry that was published in 1922, and that really made this point that the income shock, the commodity price busts, led to massive deposit withdrawals. So as it says here, the farmers in agricultural districts were unable to sell the products for enough to liquidate their bank loans, and so had to withdraw, also to make ends meet and to pay down debts. And the report also provides some initial statistics on that, showing that changes or losses of deposits were strongest in agricultural counties relative to and much less so in semi-agricultural counties or non-agricultural counties. We also see that banks in agricultural counties borrowed much more from the Fed and from their correspondents than in semi-agricultural counties and non-agricultural counties, which also suggests that they had a funding issue, especially during these first years of the bust. What we also know is there's also another source that is kind of useful to understand what was going on. Namely, the annual report of the control of the currency reports exact qualitative or narrative reasons for the national bank failures at this time. And when we look at these reasons in detail, we see that only about 16% can be ascribed to some sort of asset side losses, whereas 54 in number of the suspensions at the time, namely a little bit more than 23%, were actually due to withdrawals, heavy withdrawals, inability to meet demands, etc. That would point to liability or funding issues that the banks had at the time. So apart from this initial commodity price bust, where do these withdrawals actually come from? So to understand this, we built a simple model in our paper. I'm only giving you the intuition of this model here, that essentially links farmers' decision to default in their loans to their expectations about future returns on their farming activities. And the most important upshot from this model is essentially that when farmers decide to default because expectations about future prices are low, as a consequence, they lose their farm, and they need some other way of livelihood. So essentially, they move away, and when doing so, they take their savings with them. And so our story goes a little bit in our story builds on this very simple mechanism. And when we ask the question, so where did deposits go? It seems that there is some plausible evidence that something like this happened. So this is now for the entire 1920s, what happened to deposits per capita in counties in the United States. And when you look at agricultural counties versus semi-agricultural versus non-agricultural counties, you really see that kind of difference, that you had strong inflows in non-agricultural counties of deposits, whereas you have really outflows or subdued growth rates in semi-agricultural or agricultural counties. Now, based on this kind of like very simple framework, we now proceed to regression analysis and look at what we can actually find out when we just run very simple county level panel fixed effect regressions. So we have three outcomes of interest here. So first of all, of course, our distress transfers per 1,000 farms. We also use log change in deposits, which is our proxy for withdrawals. And then we have the suspension rate for all banks, for national banks, and for state banks. We have our proxy for the agriculture price shock is this typical crop index that we construct exactly in the same way as papers have done before us. In this specific case, we use the paper by Jaremsky and Wheelock to compute that index, and we also use a vector of control variables that we interact with time dummies to be able to control for them in our panel setting. Now, what we do with our data, or with our novel data, but also with our story, essentially, we run three very simple regressions. So the first just looks at how distress transfers are associated with the commodity price shock. So here we show essentially this kind of first prong that we really see the price shock is strongly correlated with distress transfers at the county level. That's not surprising, but it's also like another sanity check that what we have in the data makes sense. So essentially, we see here that a log point change in the log point change, the crop price index, positive change reduces the number of distressed farm transfers by about 6 per 1,000 farms at the county level. And we also do this for we include district fixed effects, district year fixed effects, etc., and provide other types of robustness checks here in this table that I'm not gonna go into detail here now because I'm running short on time. Now the second sort of prong we look at is whether the commodity price shock also led to deposit withdrawals, or is also associated with deposit withdrawals, as our framework would predict, or as our story would predict. And we also find this positive association between a higher a higher crop price index and more deposit inflows, which means that by the other way, essentially, so if prices are lower, then we have more deposit withdrawals in a county, and that result becomes stronger if we use district year fixed effects, for example, meaning that when we control for potential policy differences across Federal Reserve districts, that result becomes even more important. Now the third regression that we run in this paper, again a very simple one, but this is now essentially the horse race. So we have shown that commodity price bust led to on the one hand to this to more distressed transfers, but it also led to more withdrawals. And now we look at essentially a very simple horse race where we predict suspension rates at the county level using our new proxy for the asset side distress and for the log change in deposits. And in this case, we do this, we standardize our variables. So what you see here are the marginal effects for one standard deviation increase in the independent variables, which means that they are directly comparable. And what we see is essentially that even though the asset side seems to have mattered, so higher distress transfers led to a higher suspension rate, the association is less precisely estimated and is also economically much smaller than the association that we see between suspension rates and deposit withdrawals. So we have run this result for all bank suspensions, for state suspensions, for national suspensions, and basically this result is true no matter what type of combination of outcome variables we use here. Now, this is sort of one of the main takeaways of our paper, is that when we do this horse race, we actually when we do this horse race with a nice fine-grained measure for the asset side, it seems that what actually mattered more at the time were these deposit withdrawals, and that's sort of the message that we send with this regression table here. So we also have several extensions and robustness checks in the paper, broader definitions. We also look at the role of that membership of state banks, for example. We also run this at the bank level for a sample of a couple of 20 states, just to make sure that the results hold, and they do. And so if you want to talk about this more, I'm very happy to go into detail and show you these results. Now, I'm gonna jump this to spend the last couple of minutes that I have on the mechanism that we thought about a little bit in the beginning, or in the theoretical framework that we have in mind. So why do these withdrawals come about? What do they have to do exactly with the commodity price index, or the commodity price bust? I mean, and so just to give you a reminder about what we have in mind, is that withdrawals happen as farmers, first of all, smooth the initial income shock, of course, but then also they happen as farmers choose to strategically default during the 1920s, so throughout the years that come after the initial shock, and withdraw the savings and move away, essentially. So in our theoretical framework, as I said, we have this specific role for expectations, because the farmers will only decide to default on a mortgage loan if if the expected return to continued investment is low enough, and relative to, you know, keeping to paying down essentially demolished debt, holding on to the land, and, you know, staying a farmer for a longer period of time. So what this means essentially is that if you believe in a price recovery, or if you expect prices to recover, then there will be less defaults and also less withdrawals as a result of this. So this is the kind of fundamental channel that we have in mind when we think about where these withdrawals come about and how they are connected with the deposit with the commodity price bust. So what kind of evidence can we provide for this fundamental mechanism? That's where the second database of our paper comes in, essentially. So as I said, we collected this database on monthly price and monthly future prices for a couple of crops in the United States. So we collect this data from the Chicago Board of Trade, and so essentially we have future price data consistently over the 1920s for 4 crops, namely corn, cotton, oats, and wheat, for several delivery dates in the year, and for forward horizons that vary but go up to 11 months. So essentially we have the price expectation as of, for example, February for December at the end of the year, within 1 year. And so our proxy for expectations, for farmers' expectations, is essentially this difference between the future price and the spot price at the moment when the expectation is formed. We collect this data for these 4 crops, and we operationalize these data then in our framework by essentially revenue weighting the expectations at the county level. So here, and I'm gonna come back to that in a second, we sort of pretend that all the counties only produce these 4 crops, and then we revenue weight the price expectations at the county level for each year. And we then introduce these expectations in our regression framework, in our very simple, county panel fixed effects regressions. And we see, we test whether these expectations, when farmers expect recovery, or when they expect, in contrast, prices to stay low, what kind of effect this has on distress transfers, so on foreclosures, or on defaults, essentially, on our proxy for defaults, and also what this means for deposits, etc. This setting has a couple of challenges. As I said, we pretend that all counties only produce these 4 crops, which is obviously not true, and so because we only have data on these 4 crops, we cannot really do any better on that. But we use a couple. So what this essentially means is that the effect of these expectations is likely to be downward biased in our context. And so we use 2 estimation approaches to deal with that problem. On the one hand, we restrict our sample to counties where these 4 crops really make up a large share, namely more than 80% of revenue in 1920. And then we also use weighted least squares, where we use the revenue shares of these 4 counties, of these 4 crops as weights in the regression. And when we do that, we find some evidence for exactly the kind of channel that we have in mind. So we find this negative association between expectations and involuntary or distressed farm transfers of real estate. So this is the first two coefficients that you see in this plot here. So if you have like an increase in expectations, or if there's an expectation of price recovery, you see less foreclosures in the county, essentially. In contrast, you see exactly also what we would expect if expectations are higher, or predict some sort of a recovery. We actually see also less deposit withdrawals in these counties. The effect on bank suspension is much more imprecisely estimated, but this has also to do, we think, with the fact that that the expectations are kind of a blurry predictor of the change of deposits, as you see here, and you know, also related to the kind of other problems that we have with the impreciseness of our proxy for farmers' expectations. Now, just to sum up, essentially, I think I have 1 more minute maybe. So basically, conclusion-wise, what we do in this paper is we look at the questions of why banks failed en masse during the 1920s. We have this conventional story that focuses on asset side losses, which we don't say is wrong at all, but we say there is also another channel that seems to be equally or perhaps even more important, namely a complementary funding channel, essentially, and we provide evidence, you know, in the form of a small model, but also in the form of new data and panel fixed effects regressions that we have shown here in the paper. What we also want to do with this data, and that's sort of an outlook, I guess, for future ideas of research, is we want to understand better what the role of the pre-existing legal differences at the state level was for the choices between different ways of resolving delinquent farm debt, so foreclosures versus bankruptcy, etc. And also, of course, an important question, a follow-up question in the context of the paper, is what happened to these farmers once they moved away and went to search another livelihood in other places, perhaps more urban places, and so forth. So thanks a lot for listening to the talk, and looking forward to your questions. Handing over to Richard, I guess.
Okay, I am handed back over to. So the floor is now open for questions, and let me something happened. There we go. And as we do that, I'm going to take chair's privilege and just ask a random question or two, just because a couple of questions. First of all, I really enjoyed this paper, and as someone who's worked on banking crises during this period, I learned a lot from it, and I really enjoyed the presentation. You mentioned in the paper, you talked a little bit about looking at, if I can get this back, sorry. You mentioned, okay, I'm still out of, let me just, okay, I am unable to get back. No, it's still not there. We'll get there eventually. I'm closing all kinds of things. All right, so I'm still losing things in the chat, or I'm not. Okay. So yes. So rather than ask my own question, which is sort of a little bit related to this, Bill English asks about the results regarding Fed membership, and if I can tack on to that a little bit, I guess I'd like to find out what's the you mentioned Fed districts as a measure of interest rates, and I'm just wondering if you can actually use those, if you've actually used those different interest rates.
Okay, so thanks for the first question, also to Bill. So yeah, I'm just going to show. I'm just going to put up first of all the Fed membership regressions, of course. In a second, I'm going to just click on this here. But before going there, so have this. So why do we even think that Fed policy could have mattered? Of course, during that time is have this other paper where I show that the Feds during this period actually used very different policies, especially during the bust years, in the way how they dealt, you know, with the banking boom that happened at the time, and so yeah, so since they use different policies at the time, we control for year fixed effects to make sure that this is not driving, you know, differences across counties or the kind of variation that we pick up in the regression. That's just like a very vague kind of background comment on not vague, but sort of background comment of on this topic. But so when we now specifically look at Fed membership and banking distress, we sort of find exactly what you would expect. So here, what we do here essentially is we interact, the log change of deposits with the share of deposits at member banks, and this specifically, of course, is interesting for state banks, part of which were Fed members, and another part of which were not state members. So what we see here is exactly that when so it's like what we see here is when is that the negative effect of log change deposits on bank suspensions, in the sense this connection between deposit withdrawals and bank suspensions was actually driven almost entirely by those state banks that were not members of the Fed. So if you look at this interaction, it kind of goes into exactly the other direction. So the higher the share of state member banks in a county, the less or the smaller is this negative association between the log change in deposits and state bank suspensions. So so it seems that Fed membership really mattered a lot during this period for bank survival, essentially. So those state banks that could tap into the discount window were those that were less likely to suspend.
Did the fact that the different Federal Reserve banks had different interest rates, does that play into this at all, or?
So that's why we use the year district fixed effect essentially to control for different time trends across the Federal Reserve districts. We think it could have mattered, and my other paper suggests it did, because these policies, this kind of financial stability policies that the banks used in between 1920 and 1921 actually led to different levels of so one of the side effects of these policies was that some of the banks that were treated by these policies accumulated large liquidity buffers that then helped them to survive and so forth. So there is a connection that is important, and that's related to sort of what you mean with the different types of interest rates that the Federal Reserve banks at the time had.
Okay, and Bill follows up with that and wants to know if the coefficient on your cross terms depend on the district.
Sorry, if the coefficient on
your cross term, which I assume is the change in deposits times share of deposits at member banks. That is, you've got controls for the different districts.
So we have like district year fixed effects here as well in this Fed membership banking in this Fed membership regression, as you can see here in this table. We could, I mean, if you wanted to look at whether the effects are different across different districts, then we would have to perhaps like include explicit interactions with across the different districts, or run the regressions for different districts in different samples. We haven't done that yet. It's something we can look at, and I will note down.
Okay, let me throw in another question from the list, and that is, was a pro-cyclical increase in agriculture debt during the time of increasing agricultural prices found? So was there an increase? Do you have I guess the question is, do you have data on the level of debt, and does that seem to be working pro-cyclically?
Yeah, so I think so I showed this if I go back to the introduction slide, or like the historical background slide. So I mean, there are a couple of papers who provide really good overview on these aggregate numbers, like for example Jaremsky and Vlog. So let me go. So I think this is the slide that I was referring to. Yeah. So essentially here, if you look at the number the second bullet in the second sub bullet of the second bullet here, you see that mortgage indebtedness really rose massively during this period when the farm price when the agricultural price boom was going on. So you have a strong connection between these two things, right? So you have this price boom. Farmers react to it in order to be able to deliver, or to benefit, to ride the boom. They want to expand their production capacities to be able to sell more, and therefore they get indebted, and they do get indebted to a very large extent.
So there's another question from Michel Lepetit, who inserts a very long quote from Friedman and Schwartz, which I will not which I guess I can summarize. But they ask that, basically make the point that the failures of the suspensions of the 1920s were qualitatively different from those of the 1930s. And I guess the point of the quote is that the failures of the 20s didn't set off any generalized liquidity crisis, and those of the 30s did. And I guess, do you have any thoughts about that on the analysis of loans and deposits? And I guess the thing that I'll just throw in for you to either comment on or not comment on is, the asset side and the deposit side. It's hard for me to imagine that these are generated by different, that these are sort of totally independent of each other. And I recognize that that's a problem. I'm wondering sort of how you cope with that, or are there other things you can do to bring those together? So answer whichever you'd like, or however you'd like.
So what you mean, I guess, is because of loan creation, deposit creation, and so forth, that the two things are kind of connected. So if you grant less loans during a certain period, you will also have lower deposits and so forth. Of course, yeah. So that's something I think we can do. We can get a handle on by looking more at the bank level data, and then see whether there is some sort of disconnect between deposits and lending during this period, or whether the whole thing is actually driven just by less lending, and therefore we see this. For example, it could be that in agricultural counties there is less demand for new loans, and therefore you have less deposit growth in these areas, or something like that, just out of a pure supply demand kind of mechanic here. So it's something that we can definitely do, and it's on our to-do list already. So that's something we will definitely look into. Regarding the question by Michelle, so I have it in front of me right now, and if I interpret it correctly from what Richard summarized, essentially, it hints at, so hopefully, maybe you can follow up on this, Michelle, if I got it wrong. But so is the idea to ask, so why did it not spiral out like it did during the Great Depression, essentially, and why did it stay sort of localized in a certain way? I think one important difference between the two is essentially that so our story is more like, if you will, it's like a fundamental story to deposit withdrawals. It doesn't have to do anything with panics. So there were a couple of, even though there were a couple of local banking panics, they are not driving at all what we find in our paper, essentially. So it's not that there are panics and that's why these withdrawals happen, and there's no contagion or something like that we would see a lot during the Great Depression. And so I think that's one of the major factors that can explain why this did not just like explode, essentially, and stayed relatively localized. And it was also a relatively localized shock in the sense that it affected first and foremost agricultural counties, and it affected them hardly in a really tough way. But it was something that was one sector and very specific, essentially, right? Because of that very targeted kind of commodity price bust.
Great. I think Rui had a question.
Yeah, I had two questions, but the first was already answered. The second, so I was looking at the picture of the the price futures, the one you've shown. And I don't know if this is just for cotton, but it strangely was almost always in backwardation mode, right? So sub question one, how is this possible?
So,
And two, was there some kind of ongoing liquidity squeeze at the CME? And two, are the horizons really fit for what you want to make of them, right? So you want to see, so you want to use these 6 or 12-month horizons as the information that your farmers were thinking whether, to stick around or, or move from the farms, right? But it's strange, right? I know that futures always miss the future, right? In a certain sense, but it's strange that even during from the 1921 something all the way to 1924, they were always in backwardation mode, even though prices were going up. So I guess my first question is, why? Do we know anything what was happening in these markets in this period? And two, do you think that this would be the actual horizon to form the relevant expectations?
So I have a straight answer to two. I think to one, I'm not 100% sure I can give you a satisfying answer. So regarding two, I mean, I 100% agree that ideally we would have much longer term expectations, right? Because as a farmer, you make a decision about whether you continue your farming life or hold on to your farm and produce based on what's going to happen over the rest of your life. Essentially, you have this mortgage, right? And defaulting on it is a huge decision. And so ideally what we want is some sort of long-term expectation, much longer than 12 months or even we have like most of the time 11 months actually. So that's the longest we have. So it's not at all ideal. And that's also one of the reasons why we think our results on the mechanism are not like the strongest that we would like them, or as strong as we would like them to be, but it's the longest horizon that we can get for this kind of data, unfortunately. And we thought really long and hard about what kind of expectation data we could get, but this was the best we found actually in terms of like frequency, especially, and in terms of coverage as well. So yeah, I 100% agree that this is not ideal, but perhaps it was so at the moment it's the best we can do. If you have, of course, other ideas and so on, we would be very happy to we also played around with ways how we can construct longer term expectations out of adding these shorter term ones in some way. But that's also kind of, that doesn't really change the fact that the underlying data is not really what we want, right? The first question is about, the backlogging, I think you said. You
Backwardation, right? So it looks like the future price is always expected to be lower, right?
Yeah. It's not always the case, right? So I mean, beginning of the mid 1920s, so 1924 around, you have this kind of like short recovery phase where people think that prices will go up. But most of the time, you have this, especially, and we also were kind of surprised about this at the beginning when we looked at the data, is that people already expected prices to fall substantially when the boom was still going on, right? So so it's interesting in some way. So markets kind of seem to have known already what was going to happen before it actually before it arrived. Later on, you see that there are expectations that are either stable, actually, look at 1927, this graph, for example, or actually even higher than the current spot price. But it took some time, and I think may have to do with how strong this correction was in the beginning, and how strong also the boom was. And maybe markets just felt there is some more correction that needed to be done, given that we have this massive expansion during the years before the war, and it was not justified and so forth. But that's the best answer that I can give you.
Could be, right? But your answer assumes that there's infinite liquidity in this futures market, which is usually not the case, right? So it could just be a liquidity squeeze whereby there's excess demand for hedge that is not really being supplied in the market, and you know, this could provoke this backwardation, right? So maybe farmers were so risk averse, so they really wanted to fix, you know, the future prices of their production, that they actually effectively pay the price for that.
Okay.
So, but I don't know, right? So
yeah, that's an interesting thought.
It's an alternatively
alternative
equivalent story, but I don't know the details. And how long was the typical mortgage, agricultural mortgage?
So I think I have it somewhere in the paper, but it was several years for sure. So it was, I mean, Richard might know that better, but I think it was about 3 to 5 years or something like that, if I'm not wrong.
How much? How many years?
5 years or something like that.
I think it was 5 years or less.
Yeah,
I think you do mention that in the paper.
Yeah, 3 to 5 years or something. Yeah.
Yeah, that's yeah. Before we go on, we're opening up. We're not done, but we're done with the formal part. So we'll have a little more informal chat. But before we go there, and thanking Kilian and all the participants, I want to remind everyone that in 2 weeks, on November 27th, Sunju Lee from Oxford will be presenting a paper in this seminar with co-author. I don't know if I don't suppose the co-author will be here, but I don't know. Mark Dordal Carreras from Hong Kong University of Science and Technology on the spatial transmission of U.S. banking panics. Oh, we're back on U.S. banking panics. How wonderful. Evidence from 1870 to 1929. So those are my official announcements, but now we're still here, and we're going to continue on with discussion as long as there is discussion to be had. So feel free to send questions. There are all kinds of comments. Someone apologizing for showing up late. They had their time zones wrong, and I will extend apologies. And all kinds of comments. I want to get back to you had mentioned, okay, well, Nathan's got his hand up, so let's go with Nathan.
Hi, Kilian. A great seminar. So I was wondering, so if I get the story correct, so there's a story about something happening on the asset sides where sort of you have these failures, and you're putting some emphasis on the liability sides as deposits, as a source of one of the contributions to crisis. There could be some correlation between them, but you're saying this is kind of an independent channel. So thinking about the liability side again, so again, I have no idea about U.S. banking at this period, but just asking about the capital of these banks and what's happening on the capital side of these banks throughout this period. So if there's some adjustment by banks to adjust for the decline deposit, to bring in new resources, or where these banks get their capital from. Is there some market where we can see some expectations about these things at those banks that are exposed to the agricultural, because if there's some market, so they see the futures, they see what's happening. So is there something that we can, just, I mean, I'm adding another channel here, which is on top of the assets and the deposits, but the capital side is pretty important because in explaining what happened unfolded later on.
Yeah. So I think there are like two different parts to your question, or like at least I interpret it this way. So please correct me if I got it wrong. So the one is like essentially how did they replace deposits that they lost during this period? I guess what other types of funding did they get if they could? I think so. One of the reasons that we have in mind why the banks suspended is because they became unviable because they didn't have the funding anymore, and so that's I guess one one answer that I can give you. The other answer that I can give you as well is that as we showed in this one graph, at least, or in this one like small let's say it's a small it's from the where do I have it from this report of the Joint Commission of the Agricultural Inquiry, what you can see here is essentially that at least at the beginning, so before the banks started to suspend in large numbers, what you see is that those counties that got hit by deposit withdrawals in a substantial way, namely the agricultural ones actually, and which fits with our story, are also those that then borrow most heavily from the Fed, and also borrow most heavily from the correspondent banks. So they really try to sort of substitute in a way the funding that they lost. And that's how we interpret these numbers, at least. And I think that would make sense. And I think it's something that you would do in the short run. The question is, does it make sense to do this in the long run if you can't get any other funding sources anymore? Then perhaps that's where our story actually comes in, that that's when you become less and less viable as a bank in a rural community, because you cannot lend out anymore, and you don't have the funding that you would need to have permanently successful operations, essentially. And the other question, so that's the first, and the other part of the question, how I interpreted this, can we actually look at share prices or something like that to see whether people sort of expected that, or whether markets thought that some of the banks would go under? And here the answer is that lots of these banks were not traded, but some of them were, and maybe we could actually look at that, I guess. So we could look at whether banks that should have been more affected by these kinds of by this kind of agriculture shock saw stronger price declines, because people thought that that the share, the value or the dividends in the future would go down in these areas. So that's something we could probably check and test. And I think you also asked me about, what's the role of capital in general, like in the sense of like capital ratios in this. And that's something we can't do with the county level data, but something we can do and we also did actually with the bank level data that we have, and there you just see what you would expect, in the sense that that higher capital ratios is something that helps you survive during this period, but it doesn't. So if we control for that, it does not do away with the results on deposits that we find, essentially. So I hope that.
Yeah. So if I follow up briefly on that, so the fact that banks, so you're pointing this lack of correlation or relationship between the capital ratios and the deposit withdrawal as establishing the fact that it's mostly on the demand side, in terms of people in agriculture actually experiencing some difficulties withdrawing their deposits to finance whatever they're. So so that would be something that would strengthen your narrative, I think, if you can show this more formally, I guess.
Okay.
Yeah.
Rui?
Yeah, just to piggyback on what was it, the second item of Nathan's questions, right? So you could look at stock prices of listed banks, but you also could look at the credit ratings, right? And I think Moody's, at least unfortunately only from 1928, starts publishing the credit ratings of financial companies and banks. And they did this for thousands of institutions. So this, your banks are probably going to show up there with a higher frequency than in some stock exchange price lists.
Cool. Thanks. That's a good idea.
You mentioned at some point, if I can jump in, you mentioned at some point looking at state deposit insurance systems. And there are a whole, in terms of the state banks, one of the things I love about state banks in the US at this time is there are all these institutional differences. So the national banks operate under the same rules everywhere, but the state banks have all these, you know, I don't say quirky, but they have different things, different capital requirements, different deposit insurance, double liability, many of the things of which I've gathered data on. And I wonder if there's anything, if you can draw anything out about banks, if you have banks with similar agricultural profile, states with similar agricultural profiles, but different regulatory profiles, there might be something interesting in that as well.
Yeah, definitely. So I think there's also David Wheelock has written a paper on this, where he actually looks at bank failures in the 1920s. I think at the state level, if I remember correctly, and where he kind of looks at the differences in terms of regulatory issues and so forth. So there is a paper on this in some sense already, but you know, we have this county level data, so we could look at that, kind of disentangle that more. We do control for deposit insurance at the state level, so we do control for that, but we don't have, you know, we haven't looked at other kinds of things. So in a sense, I think what you would like us to do is to go more into not only district year fixed effects, but more like also state year fixed effects in a way, because then that would control for changes in the regulatory requirements or regulatory environment over time in these specific states, especially when it comes, of course, to state banks, because national banks, that's another story, as you already said.
But when you say you're controlling for deposit insurance, is that explicitly in there, or is that part of the fixed effects? Oh, it is explicitly.
It's explicitly in there. Yeah, so that's something we have explicitly in there. Interactive with time dummies to be able to have it in our context, but yeah, it's explicitly in there. Yeah.
But why that and not minimum capital requirements, for example? Well, I mean,
we could definitely do that as well. So we should probably do that as well. Yeah, deposit insurance, I guess, was the one that we had on the mind because of, you know, obviously our story, but also because of the papers, I guess, that we read for this, for David Wheelock, who looked at this and so forth. But we should definitely think about that more. Yeah.
Okay.
Liability requirements, I guess, as you said, double liability versus
It looks like we're reaching the end. I think at this point it's for me to just thank Kilian for such an excellent paper. Lots of complimentary comments and lots of thank yous in the Q&A I saw going along. So thank you for that. I don't know if the organizers have is there anything else that needs to be mentioned at this point in the seminar? They are both muted and they're both shaking their heads.
No. So just to thank Kilian and Richard again.
Yeah, thank you.
For leading the show today, and say, you know, whoever is still on the call, we look forward to see you in 2 weeks.
Great.
All right.
Thanks.
Keep well.
Or next week.
See you next week, Kilian.
Yeah.
Bye.
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 All right. Okay.